from our studio in New York City. I'm Julie Hyman. That's Josh Lipton. This is Yahoo Finance Live. And here's what we're watching this afternoon. A warning on the consumer from America's largest retailer. Walmart seeing a slowdown heading into peak holiday season. And it's not the only company raising these concerns. Other retail stocks to watch today include Macy's, Bath & Body Works, and Williams-Sonoma.
And a major mover today, that is oil. Crude sliding 5% on the day and pushing the commodity into a bear market. Mounting demand concerns weighing on the oil market as inventories rose in the latest week.
Plus, General Motors' tentative deal with the UAW is now official. Workers ratifying the contract, making it the first of Detroit's big three automakers to get the deal approved. The focus now shifting to Ford and Stellantis. Those votes are still being tallied. Let's get you up to speed right now on the market action as we look at the three major averages here. We do have not a lot of movement on this sort of top line. You got to dig below the surface to get that. The S&P, the Nasdaq, very little change to the downside today. The Dow off a little bit more, about 123 points, or about a third of 1%. Energy stocks, we just mentioned that oil is a big drag today. Energy stocks are the biggest drag there. That's the reason for the Dow's underperformance. But consumer staples are also lagging along with discretionary. We're going to dig more into that in a minute, Josh.
Yeah, we're taking a bit of a breather here. I mean, we did have this relief rally, inflation coming in cooler than expected. So investors decide, okay, Jay Powell, those central bankers, they're going to be on hold. You saw yields come in. And that's still what I'm laser focused on. I look at the U.S. 10-year here, Julie. We were at 5% at one point now. We went back down to 4.443. Look at the 2-year. We're now back to 4.842. And when we talk to some strategists, at least, that's what they're focused on, too. They think that is key here. And what do they want to see? They want to see stability in those yields, not rocketing higher, not crashing, stability. We've talked to some smart folks who think that's really the key to the direction of the equity market here.
Yeah, and that's one of the reasons, by the way, that utilities are helping lead some of the gains that we are seeing again today.
Yep. Let's get to the state of the consumer is in focus on Wall Street today after Walmart raised concerns about spending. The company's CFO joined Yahoo Finance earlier today and talked about the slowdown it started seeing at the end of October.
As we look into November, and particularly around some of the events that we've had for our holiday shopping, we've seen pretty good strength. And so what that tells me is that the consumer is being discerning, maybe choiceful, and buying these more discretionary items, these larger ticket items, and they're leaning into these promotional or holiday type events to buy those items. And the shoulder periods around that are a little bit slower than what we've seen previously.
And Walmart wasn't the only retailer raising concerns today. Let's bring in Yahoo Finance Executive Editor Brian Sozzi into this conversation. So Sozzi, let me get your take. I mean, as you've kind of spoken with these retailer CEOs, you've been there talking to the C-suite as you look through their earnings report. What are some of your big takeaways?
Walmart did not lay an egg. And I understand why the market is selling off this stock. Walmart shares 52-week high coming into the report. A lot of expectations built into this. And yes, there was some operating margin pressure year over year because of higher wages. But when you drill into this quarter from Walmart, checked a lot of boxes, at least for the bulls, who probably sent that stock higher into this report. Inventory in the U.S. down 5%. 4.9% comparable sales increase in the U.S. business in the quarter. Oh, yeah, what did Target do? Their comparable sales were down 4.9% in the most recent quarter. So Walmart continuing to take market share in the business, not only from Target, but from grocery stores. Another big quarter for groceries at Walmart. Immediately has me thinking, well, that quarter from Kroger, a lot of other grocery stores, probably not good.
There were a couple of other things that stood out to me, not just from Walmart, but from other retailers as well. For Walmart specifically, I thought it was really interesting to hear the word choiceful again
from
like Walmart.
Word.
You like that word?
Is it one
right?
word? Is it a dash?
It's just selective. It's another way of saying selective. And John David Rainey, the CFO, is talking about shoppers waiting for events, waiting to almost be forced into buying things. He pointed out, for example, Walmart has 25 toys priced at under $25 to try to lure in customers, which makes me think if Walmart is so focused on discounting, what are we going to see from some of the other retailers as well, especially those who are catering to a perhaps mid to lower income consumer?
No, right on, Julia. And really, three things make a trend for me. So we heard Walmart say people are buying closer to need. That's the same exact thing that we heard, or I heard from Target CFO on their earnings call as well, saying consumers are waiting to the last minute to buy a pair of jeans, waiting to the last minute till it snows or it gets cold to buy a jacket. Going out a couple weeks ago, that's also what we heard from Levi's CFO on Yahoo Finance too, talking about a slower than expected start to the quarter. Now, if there's any savings grace here, retailers are fundamentally in a different position this year versus last year. So while they might be feeling the impact of student loan payments kicking back in October 1st, you saw sales start to soften for these retailers since then. A lot of them are in a better inventory position. Last year at this time, they were sitting in an inventory glut. This year, inventory down pretty much across the board, even at a company like Macy's.
Do you think, Brian, after you read through these earnings reports, you listened to the commentary, that we are perhaps seeing signs of this kind of lower income consumer recession? Because it's been flagged by some analysts. They're looking at savings, they're looking at credit quality deterioration, they're looking at confidence. It's been a theme some are flagging.
I had never heard of this theme really until 2 weeks ago, and I think it was Allianz Bernstein that came out with a really good note talking about we're in a low-income consumer recession. Can you make a case for it? Absolutely. You have that low-income consumer still battling high levels of inflation in everyday essential items. So I know the market cheered a CPI report yesterday, and things might happen. We might see disinflation. The average consumer going to Walmart or Target are just not feeling it yet. They're still seeing product prices for groceries, household staples up 15, 20, in some cases 30%. Brian Cornell, CEO and chairman of Target, noted on the earnings call yesterday, baby formula up 40%. So the average household's still dealing with a lot of problems. And oh yeah, here's a $500 now they have to send out for student loan payments. A lot going on. What does it mean? Less discretionary purchases.
At the same time, I think we have to separate out what the effect of that is going to be. Because even at a Walmart or Target, if they can preserve their margins, even if the sales are down, as in the case of a Target, for example, they're still going to be okay. And Bank of America has said that if you back out and look at the bigger economic picture, that higher income consumers are much more important for the bigger consumer spending picture. Just to mention a couple of other companies that we heard from in the consumer space, I was looking through some of the other conference calls. We heard from Bath and Body Works, who said they continue to see the customer carefully managing spending, that pressurized basket size and conversion. Based on what we're seeing with the cautious consumer and continued market declines in two of our categories, candles are one of those categories, and they're talking about continuation of softer top-line trends in the fourth quarter. Also, Williams-Sonoma said the results they achieved were in an environment filled with ongoing consumer hesitancy on high-ticket discretionary furniture and elevated levels of promotional activity. Now, a lot of these various retailers are handling it in different ways. Williams-Sonoma has stood out by not offering discounts. They've really been holding the line. But we are likely to see a somewhat promotional holiday season otherwise.
Right, and we heard it from even Home Depot early in the week. Any item really that you don't need and priced over $500 that you have to put on a high interest credit card in this higher interest rate environment, people are not buying. Now, if there's any positive trend to call out, it is beauty. And this is a topic our senior reporter, Brooke DePalma, is digging into. Beauty across the category, Target, Blue Mercury and Macy's, even Walmart within their health and wellness business, very, very strong. Why? Because a lot of these price points are still somewhat attainable, and these are items that you run out of and you need to replenish them.
I'm trying to look. When's Ulta reporting? On the 30th, on or around the 30th. So
maybe a good quarter. Just connect. I'm not predicting. I'm not predicting quarters or stocks, Julie. I don't do that stuff. I don't do that.
At least not on camera.
Yeah, no comment. No comment. You're not getting me.
Brian Sozzi, thank you for joining us, sir.
Thank you.
Fantastic. Shoppers are still flocking to Walmart, but America's largest retailer is sounding cautious about the future amid an uncertain macroeconomic backdrop. The store's earnings follows suit of other retailers like Target, TJX, and Home Depot, all beating on the top and bottom lines this week. But the market reaction has been mixed. We know that. Here to break down is Ed Urima, analyst at Piper Sandler. Ed, let me bring you in here, and you're the perfect guy, Ed, to talk about this. You know these names backwards and forwards. As you look through the reports, Walmart and Target, what were your big takeaways, Ed? What did it tell you about the state of the consumer right now?
Look, I mean, as you guys mentioned earlier, the consumer is being very choiceful. They're being selective in terms of what they're buying. Obviously, there's continued pressure on the consumer from things like inflation, that even though there are pockets of areas where we're seeing deflation and disinflation, it's still, when you look on a 2 or 3 year basis, still it's a very difficult environment for the consumer. So I think when you kind of net all that out, you're ending up with a holiday season that, potentially is kind of lackluster.
And so how is that going to play out for the likes of a Walmart versus Target? And obviously, we've seen such an interesting discrepancy in reaction here. One could argue, in some ways, Walmart actually did better, but expectations were already high going into the quarter, and Target was the opposite. But I don't know what that tells us now about how the holidays are going to be for these guys.
For Walmart, they kind of introduced this theme, and we've started to grapple with it, of what happens to grocery in a deflationary environment, right? It's clearly been a nice comp tailwind for them. They benefited because you drive more, footsteps in the door, and then you can buy other things within the store. So Walmart, has clearly been a strong beneficiary, I think, of stronger grocery trends. Now, they would argue that if we get deflation, then that's more money that the consumer can spend elsewhere and hopefully spend at Walmart. But I think it's just a different shift that the investors having to kind of grapple with. On the other hand, Target, right, it was kind of a low bar, and I think they kind of exceeded that low bar, right? They had a very difficult time last year. They are more discretionary, right? They don't have the same food penetration, and so if discretionary trends get better, you could make the argument that Target is more leveraged to that than someone like a Walmart, which has both grocery and discretionary.
And Ed, what about these comments from Walmart execs, specifically when they talked about perhaps deflation in the months ahead is what they might be seeing? What would that mean, Ed, for Walmart's business and margins, if that's true?
Look, that's the big question, right? So clearly deflation will impact top line. And the question is does the consumer buy more units, right? And so you could see a scenario where maybe you buy an extra toy or two for your kids, but probably not buying an extra bottle of ketchup, right? So I think there are some areas where there is elasticity and you'll buy more units. There are other areas where you're just going to put that money back in your pocket. And so I think that's something that, again, we're having to work through our models and think through because it's an environment that, candidly, we haven't seen in a while.
And so, Ed, your coverage universe is pretty diverse within retail, right? You cover a Walmart and Target and a TJX, who we just heard from as well. But you also cover Warby Parker. You cover some of the resale companies like a ThredUp and a RealReal. As you look at the ones that we've heard from thus far and the sort of ensemble, who in that universe can do well in this environment, or at least better in this environment?
I think TJX continues to take market share, right? That very strong results yesterday. They're taking share within apparel. They're taking share within home. And we think from some of these Bed Bath & Beyond stores that have closed. Interestingly, they also highlighted beauty as an opportunity, right? This is a category that off-price hasn't traditionally been as strong in. And as we visit their stores, we see them making significant headway there. And so that's a big opportunity for them. So I think someone like a TJX, because the consumer wants these products, right? They want apparel, they want beauty, they want home, they want this for the holiday, but they want to be careful with what they spend. And I think TJX offers consumers great value.
And Ed, what about this other issue of, we heard so much about shrink, retail theft. In your coverage universe, Ed, does that issue seem to be more in control now?
I don't want to say more in control. I would just say it's less surprising, right? I think we're starting to see the curve flatten out. I think we're starting to hear more about local municipalities that understand that if this problem isn't dealt with, then they will lose stores in their cities. And so it does seem like the retailers, local governments are at least more aligned than they were 12 months ago. So I don't think it's not a problem. I think shrink levels are still elevated. We haven't seen them come down, but they're not increasing the way that they did last year.
Does it feel like that problem is kind of, the peak of it is behind us?
It's possible, right? And ultimately, a retailer would tell you that the consumer will pay for shrink, right? It will get added to the cost of an item. And so if shrink rates are stable, then retailers can kind of price against that. So it does feel like hearing them call it out on conference calls as being a headwind to the business is probably largely behind us.
Eddie Umar, thank you so much, Ed, for joining us today for that time and insight. We really appreciate it.
Thanks.
We're just getting started here on Yahoo Finance Live. Coming up, mortgage rates declining for the third week in a row, but other factors might keep home buyers out of the market. We'll tell you what those are. And oil prices are plummeting today. What does it mean for your wallet at the pump? We're going to dig into those details. And Goodyear Tire has a plan to transform its business. And one analyst says there's a lot of upside to those plans. All that and more when Yahoo Finance returns.
Time now for a look at some of today's trending tickers. We start with Amazon and Hyundai Motor announcing a broad strategic partnership. As part of this team up in 2024, auto dealers are going to be able to sell vehicles in Amazon's U.S. store. Hyundai is going to be the first brand available for customers to purchase. So you buy the car on Amazon, you still have to pick it up through the dealer. What's been notable today is it's sort of a good old-fashioned Amazon gets into a business and there's sort of a mini panic in the stocks of the companies that are in theory affected. So we are seeing a number of the auto dealer stocks trade lower today. Amazon shares aren't doing much of anything, but you're seeing these companies fall. It's unclear to me exactly why, because it doesn't cut out the dealers. You still have to go to the dealership to get your car. Maybe they get a smaller cut. I'm not sure what the financials are behind this, but it is interesting to see this reaction.
Yeah, and to your point, anytime you see kind of big tech moving in with those kind of deep pockets, that kind of brain power, the flexibility they have, people get a little nervous. Sometimes you do see these knee-jerk reactions. It wasn't clear to me, Julie, how many dealers exactly were talking about jumping in here exactly right away, whether that really is across the country, whether this is going to be available, or what demand is going to be. I mean, I myself, I think I'd be kind of uncomfortable purchasing a car online, but I realize, listen, that it is something that more people are getting comfortable with. You could see some momentum there, especially when you have a name like Amazon moving in.
Well, and especially say if you're a repeat buyer, right? Say you were a Hyundai customer, you've owned them before, it's a known quantity to you. There are two more interesting parts of this announcement, I thought. One is that Hyundai is going to be partnering with AWS as its preferred cloud provider. But the other thing is, starting in 2025, you're going to have Alexa in your Hyundais. So you're going to be able to talk to Alexa like you can at home and get her to do stuff in the car, but also you can say, like, talk to Alexa in the car and get her to do something for you at your house also.
Does all this sound so exciting that you're kind of thinking about a Hyundai now? Maybe?
I have had them before.
Yeah.
But that's not enough alone to put me over the edge.
All right, maybe later. We'll see how it takes. Moving on, shares of Sofi Technologies slide as the company confirms what Wedbush notes was many investors fearing, and that there's a loss-sharing component to Sofi's loan sales. And this, Julie, is really tagging this stock today. And I mean, impressive move to the downside.
It is. It is complicated, to be clear. These are loans that the company is selling, and it all has to do with the value of those loans. Sofi has what is a somewhat unusual loss-sharing agreement, so even after it sells the loans, it can participate in the upside and downside. And David Chiaverini over at Wedbush basically wrote a note and talked about this that said it has to do with how Sofi is marking the loans. And has it made them seem more attractive, these sales more attractive than they are in reality? So the market does seem to be having some questions about this, and we're seeing a sell-off. It has to do with some comments, by the way, that Sofi made at an analyst conference today that then some folks are picking up on.
Yeah, and we should know Wedbush does have even underperform on the name, so the equivalent of a sell, and they're definitely in the minority. They're only about 9% have a sell. That doesn't mean, of course, David's wrong.
Yes.
Most are on hold. Even with today's, the bump in the stock here, and it is taking it on the chin, it has had a strong year. I mean, even with today's sell-off, you're still up about 45% year to date.
Right, exactly. And also we're looking at Alibaba today. It is scrapping its plans to spin off its cloud business. The company citing uncertainties created by U.S. export curbs on chips used in AI applications. The shares tumbling by 9%. In fact, we're seeing a broad downdraft in China-related shares today. Alibaba is just one of them. But man, what a sort of whipsaw couple of years for Alibaba investors. It was a surprise when they said they were going to spin off the cloud business. We didn't have details on exactly what it was going to look like. Now it's not doing it, at least not for now. And it's also obviously fascinating timing because we've just had the meeting of President Biden and Xi Jinping where things at least didn't get any worse.
Yeah.
And yet we're hearing this from Alibaba at the same time.
Yeah, and they clearly pin it on that. I think the money quote here is when they say the recent expansion of U.S. restrictions on export of advanced computing chips has created uncertainties for the prospects of Cloud Intelligence Group. Now, if you read through the reports today, Julie, there are some analysts out there suggesting this might not all be about U.S. export controls, that
Maybe
the cloud
it's an
business,
excuse?
well, that the cloud business, they'll note, has been slowing, losing market share. But it is certainly one to watch. And you see how, listen, the U.S. government doesn't want the Chinese government to have access to these advanced chips. They see it as a national security interest, and it is interesting how this is now causing some ripple effects in private companies.
Yeah, and then Baba shares are down about 11% this year. So this just the latest sort of downdraft we've seen for it. Well, there's another stock that we were watching today, and that is Goodyear Tire. The shares are extending gains after it yesterday announced a transformation plan that included reducing debt, cutting costs, and the sale of 3 of its business assets. The company also announcing its current CEO, Richard Kramer, will retire next year. Search is underway for his replacement. Kramer calling the transformation plan a, quote, clear path to create a more profitable and focused Goodyear. And one analyst is seeing major upside from these changes. Here with more is Emmanuel Rosner. He is Deutsche Bank lead auto tech analyst. Emmanuel, thank you so much for joining us. So you're looking at these changes as positive for Goodyear. Let's be honest here. The tire business is not a glamorous business. What are we going to see as the sort of levers that are going to be most important in that plan and what you heard yesterday?
Sure thing. Thanks for having me. I would say, look, Goodyear has been essentially underperforming dramatically, even compared to what you describe as sort of like a challenging tire business. The margins have been below peers. There's been a tremendous amount of execution issue. What we're basically seeing now is a major turnaround plan with about $1.3 billion of cost being taken out globally. We're also seeing some non-core businesses being divested with $2 billion of potential proceeds. And most critically, perhaps, we're seeing a change in management with a new CEO coming on board and essentially giving more confidence to us and probably to the market that this plan will actually be executed and that there's all this upside. And so you essentially have, it's a very, very idiosyncratic story. It's not about making a call on the tire or on the broader economy. It's essentially an under-earning, underperforming asset, an underperforming stock, which is not a transformative moment where it could essentially, through self-help, improve earnings dramatically, delever the balance sheet, and essentially unlock some shareholder value.
And Emmanuel, when you talk about these potential divestitures here, so the chemical units, the Dunlop brand, the off-the-road equipment tire business, what are those assets worth, Emmanuel?
So when you sort of like look at what they're divesting, it's probably about, call it $2 billion of revenues. Very, very profitable business, about $300 million of earnings or so, $400 million of EBITDA. So that's very meaningful margins. Even if you applied like a very conservative 5 times EBITDA multiple on this would probably be worth at least $2 billion of proceeds in terms of what they would be able to sell it for. This is what Goodyear is committed to yesterday as part of the plan. Frankly, when you sort of like look at the quality of these businesses and the margin profile, it could easily be higher than 5 times, and then that would provide some additional upside to these proceeds, therefore to the deleveraging and to the equity value creation.
Emmanuel, of course, you don't only cover tire companies, you cover the auto space more broadly. And I want to ask you about Tesla in particular, because I know that you had some investor meetings just a couple of days ago, and you came out with a note where you talk about that. Tesla, as you point out, has said things are slowing down a little bit. What is that going to translate to in terms of stock action for Tesla? Is it going to kind of muddle along here for a bit?
So as you mentioned, we were lucky to host Tesla as part of our Deutsche Bank Auto Tech conference last week, and they were incredibly candid about this, essentially saying, yes, we are in between 2 high growth periods. The last 5 years was high growth based on Model 3 and Model Y. This is mostly, maxed out or reaching full potential on a global basis. The next big growth spur will come from the next generation vehicle, which is probably a little while away, although they wouldn't quantify exactly when this will come. Right now, we're somewhere in the middle, and that essentially means relatively lower growth. What it essentially means is I think there's downside risk to investor expectations for volume. Next year, the street is calling for about 2.3 million units of Tesla vehicles being delivered. We're closer to 2.1. There may even be potential downside to 2 million units by the time Tesla guides in early 2024. The other, basically corollary is that there may be somewhat less operating leverage as a result, right? If you don't have much volume growth, you're also not going to have that much earnings growth. So I think it's important for investors to understand that we're in this low growth period for Tesla, probably for the next couple of years until the next generation vehicle comes out. What happens to the stock will essentially depend on what happens to the multiple. If investors are patient and want to wait for this next generation vehicle, which will be cheaper, could sell in the millions of vehicles, then the multiple will stay high and the stock could still continue to be okay. If people figure out, okay, look, this is too far out to wait, this may not happen until 2026. Right now, there's no earnings growth, so limited amount for the next couple of years. There could be some pressure on what is effectively a very high multiple, and that would be then downside risk in the near term, to the Tesla stock. Although again, we think the longer term story is really compelling.
Emmanuel, it's interesting that you're talking about the next generation vehicle as we're talking about the next generation of the Tesla, the core model, if you will. We're not talking about the Cybertruck. And it leads me to ask, I sort of understand what the Cybertruck is about from a coolness, from a tech perspective. What does it do for the company financially, if anything?
So Tesla was actually very, very open about this, the fact that this is going to be an incredibly difficult ramp. This is all new technologies. This is going to be a loss-making vehicle for them for at least the first 18 months, being both negative from a profitability point of view, as well as generating negative free cash flow. That will be because it's going to be a slow, painful, expensive ramp. It's an expensive vehicle to produce. And obviously there's a limit to how much they can essentially charge for it. So this will actually be negative for their cost and negative for their profitability, probably through early 2025. And then the question is, after that, how good of a job did they do at lowering the cost and maintaining sort of like a high price for this vehicle? But you're absolutely right. In terms of the longer term direction for Tesla, Cybertruck is largely not that important. This is almost like a side sort of like pet project or a side vehicle, which will fit a niche, sort of like need 250,000 units. The big game changer for Tesla, it is essentially next generation or Model 2 or Robotaxi, however you want to call it. But this would be a much cheaper vehicle, $20,000 to produce, $25,000 starting price. And it would be something that could be sold globally, produced globally, and sold globally in the millions. That's the main big next earnings growth driver, but it's probably at least a couple of years out.
And Emmanuel, I wanted to ask you too, Elon Musk was apparently at this banquet to welcome Xi Jinping. He was, of course, in San Francisco to meet with President Biden. When you think about China, how much of an opportunity, Emmanuel, is that for Tesla? Because, of course, there's a ton of competition there, including the homegrown teams like BYD.
Yeah. In the near term, it's a very limited opportunity for Tesla because Tesla is already operating at max capacity in Shanghai. They produce and sell about 1 million units a year, which is as much as this factory can actually produce. And so there's very limited amount of growth. If there's any growth at all at Tesla over the next few years in terms of volume, it would not be from the Chinese factory. It would be from ramping up a little bit Austin and Berlin factory. So very limited. Obviously, longer term, by the time they come up with the next generation, this is meant to be a global vehicle, and obviously at the $20,000, $25,000 price point would fit very nicely in some of the most competitive markets like China. And so then China, once again, should be a critical part, of their addressable market, but certainly not so much in the near term. And to your point, there's a lot of competition there. This is one of the areas where the pricing is the most challenging. As a result, there's a lot of EVs on offer, and so this is not a big part of the near-term growth for Tesla.
Emmanuel, good to catch up with you as always. Thanks so much for joining us.
Thanks for having me.
Coming up, it was a vote that came down to the wire for the historic tentative contract between the UAW and GM. We'll give you the results next.
It was a vote that came down to the wire, closer than expected for the historic tentative contract between the UAW and GM. And here with the details is Yahoo Finance's Praz Subramanian. So Praz, down to the wire here.
Yeah, I mean, it's official. GM, UAW members voted to approve the deal. Slim majority here, according to the UAW GM vote tracker, 54.7% to 45.3%. A lot closer than what people thought. Ford and Stellantis right now are in the mid-60s. They haven't yet gotten their full voting in yet. So a turning point came yesterday when a big plant in Arlington, Texas, voted for the deal. This followed a number of big plants voting against the deal, with the deadline looming today at 4 p.m. Those votes were in, so good. Everyone's celebrating there for GM and the UAW. But if you're the union, you got to look into why some of these workers were upset about the deal. I spoke to an expert about it, and he said that a lot of the older workers believe that they weren't getting what they originally had back before the great financial crisis, and they think that the new deal sort of shortchanges them to the extent that temporary workers get huge bonuses, big lifts in pay, and they think it's sort of unfair for them to not get that. So I think the leadership will look into what plants sort of had the biggest negative votes. What's the split of workers there, older versus younger, temp versus permanent? Ford and Stellantis don't have that issue with a lot of temp workers, so I think that might be what's keeping them kind of afloat more than the GM vote.
All right, well, we'll see what happens. But Pras, in the meantime, stick around because we have another auto-related story to talk about. Formula One will light up the Las Vegas Strip for the first time in decades this weekend. Hundreds of millions of dollars have been spent to create the track. It weaves past iconic landmarks, casinos, and hotels, all with cars pushing speeds of more than 200 miles an hour. The man behind the wheel at Liberty Media, the company that owns F1, is Greg Maffei, and he's joining us now, along with our own Pras Subramanian, who is an F1 fan, as well as our autos reporter. Greg, thank you so much for being here. Obviously, this has been an enormous effort in your expansion of F1 in the United States. Talk to us about whether it looks like the gamble's paying off here in Vegas.
Oh, I think it's going to be a huge success. Not only was last night's spectacle, the opening ceremony, amazing, but we have enormous demand. We have a track that I think is going to be exciting and fast and variable, which always creates good racing. But we have enormous fan interest as well. At all levels and all levels of ticketing and all levels of excitement and different kinds of fans. So we're very happy.
Hey, Greg, Pras here. So I know, with Liberty's ownership of F1, it's been a few years now, a lot of money being poured into that Vegas race, that big investment. I think it's upwards of $200 million there for that big kind of marquee race in Vegas. How much money?
Closer to 600, just so you got the math.
Oh, okay. So I guess you need to sort of recoup at least $500 million. What makes sense financially for Liberty and for F1?
Well, that's capital investment of 600, and I expect that the revenues of this weekend will approach 500 million or perhaps even more. But not only do we have enormous opportunity to make money just in Vegas, but it's an enormous growth vehicle for the business overall. We brought in new sponsors, people like Amex, who joined, people like T-Mobile because of Vegas. We have, I think, the opportunity on Saturday night to show a whole lot of fans around the world a new element with the night race down the Strip. It's going to be iconic. It's going to be dramatic. And I think people will be amazed.
Greg, what about the local residents there? You recently apologized to the local folks in Vegas because this construction effort has been very disruptive. There have been road closures. There have been restaurants that have complained about lost revenue. I mean, people in Vegas are used to spectacle, so I don't know how impressed they'll be by all of the fireworks and the race itself. How do you win them back? Do you need to win them back?
Well, I think a couple of things. It shows you never apologize. I was attempting to be pleasant and thankful for all the forbearance that they had to go as we've constructed things. We are not the only construction going on in Vegas, but we were a major element. I think Vegas is going to like this a lot. It will be the largest sporting event ever done in Vegas, bigger than the Super Bowl, bigger than anything they've ever had. And we're injecting something like $1.2 billion into the local economy. You're seeing the benefits go out to cab drivers. You're seeing it go to restaurants who are having upcharges. So I think there's going to be a lot of revenue shared by many in the community. And we hope that will do something for the benefit of all.
So, Greg, with the sort of crown jewel of the U.S. Now with Vegas happening this weekend, What's next for the U.S. market? We saw tremendous growth during the pandemic and the Netflix show and the new race in Miami last year. What's next year for in terms of like growing that market? Is it sort of hitting a saturation point?
No, I don't think it's hitting that at all. We've seen enormous growth in our fan base over the last few years. You can look at engagement across all sorts of platforms, TikTok, all other social media platforms. The United States has now become our largest market. You can look at how the fan base has expanded. In the space of 4 years, a recent study showed we've taken the average age down 4 years, and the new fan base is about 40% female. So we've got a variety of fans who interact with us in an enormous number of ways, and we continue to grow that audience and touch them in new and different ways every day.
Greg, I'm curious about the sort of characteristics of that audience, besides some of the demographics you just talked about, because F1 traditionally is a sort of wealthy person sport, at least in European terms, right? So how do you balance that sort of wealthy audience that you've had traditionally with the mass appeal that you appear to be shooting for in the United States?
Well, I think there is an aspirational element to Formula One, no doubt. It's a sport of technology, it's a sport of glamour, it's a sport of excitement. But we tried to make sure it's accessible to all. You're right. Historically, Western Europe was our base, and we did skew older. But we now have a fan base which is much more broad, much more widespread. I've been told by many parents that they're amazed that their teenage child gets up early on a Saturday morning or a Sunday morning to watch qualifying or watch the race. Maybe the only thing they're willing to get up for. And I'm ecstatic that we have that growth in the young fan base. And I'm ecstatic that we have the growth in our female fan base. It's wonderful.
Hey, Greg, mentioning those younger fans and those the new demographics there. Is it difficult here with this race? You want to have the night race at night with the Vegas Strip lit up. I know the race will be on here at New York City time at midnight. Us F1 fans are used to watching races at weird times, but do you kind of see that as maybe a mini drawback there, or is it just sort of that's just how it's going to be in Vegas?
Well, I think that's the reality. We have a global sports business, and we have races in Australia and China, and we have races in Europe, which are not always the optimal time for people in this hemisphere. On the other hand, we now have 6 races in this hemisphere. So our fans in North America and South America have many races, which are really excellent times for them. And that continues to be, we have challenges that we're global, and we have many advantages that we're global.
Greg, I hope you're getting some sleep, having some coffee over the next few days to rest up for it. Greg Maffei, CEO and president of Liberty Media, and I'm here with our Proud Subramanian. Thank you so much. Have fun this weekend. Coming up, relief for home buyers. Mortgage rates fall for the 3rd week straight, but will home prices follow? That's next.
Mortgage rates pulling back for the third straight week. The 30-year fixed mortgage falling to 7.44%. That's down from 7.5%. That's the lowest level since September 28th. For more on what this means for home buyers, joining us now is Jeff Taylor, Mortgage Bankers Association board member and Emphasis Digital Risk founder. So Jeff, 7.44%, I guess that's a bit of relief for those looking to buy a home. But what do you think the impact here is for the market?
Well, thank you very much for having me today. So look, we were at 8% this only a month or so ago. So we're 50% basis points down. I think the big sort of news is when we look at the CPI dropping this month, we're starting to get closer to 2%. As Chairman Powell said, we still have a period of time to go. And also the Fed decided obviously not to raise. So I think sort of that sentiment is, okay, we're not going to see another raise. Inflation is starting to get better. And that's where you sort of seen a 50%, a 50 basis points drop from the high of 8 down to 7.44%. I think this also will start to signal over the course of the next year an area where we'll start to see rates drop over the course of the next 6 to 12 months if the Fed continues to act the way that it is, and we're continuing to see inflation finally get more under control after the fight for the last couple of years.
And Jeff, nobody thinks that it's going to be a quick and easy process, that even if rates come down, that the housing market's going to remarkably recover overnight. But you do pinpoint, in addition to rates coming down, a couple of other things that could be supportive for that recovery. And one of them is what home builders are doing in terms of new housing. Talk us through that.
It's a great point, right? So many home builders having made the best year they've ever had this year. Yet what you're seeing is home builder sentiment has been down 3 months in a row. And about 62% of home builders are still providing incentives for people to buy these houses. So if you're looking at a market that's incredibly tight on existing home sales right now, you have home builders right now that are building at an all-time high, and 62 are providing incentives that can really make it more affordable to get into a house. That's a win-win if you're looking to buy a house right now. So I would be very aggressive on the new home builder side, looking if I was currently in the market trying to figure out what I want to do, existing home or new home.
And Jeff, I'm just interested, are there historical parallels that you see that we can look to, sort of similar housing environments in the past that kind of mirror what we're seeing now, and any lessons learned from those?
So a couple of the most important things are we have an incredibly structurally sound housing market, right? These loans that have been made over the last decade are sound, right? Debt to income ratios, very strong. I think our overall delinquency rate is about 3.62%. And if you look at the Fannie Freddie book, that's sub 1%. So, with FHA and VA, it's a little bit higher. So we look extremely sound. We have over 30 trillion in home equity right now. So even if you have the occasional, the person has a life event or a credit event, we're nowhere close to seeing mass sell-offs in any one specific area like we did maybe in 2008, 2009. So this market is very strong. It comes with its challenges, right? If I'm looking to sell my house to buy a new house, am I really going to get out of my 3% mortgage and sign up for a 7% mortgage? That might be harder to do. A lot of people might feel like I'm locked into sort of redoing the existing house that I have, or look for buying a new home.
So Jeff, when all is said and done, what's going to break the logjam?
What's going to break the logjam? What could break the logjam is we had a couple of million more houses magically appear, which is not going to happen. So I think it's going to be consistent. You're going to see home builders continue to build, which will put more supply into the marketplace. And then remember, we didn't build 6 million houses between 2010 and 2018. That's kind of one of the reasons that we're in this spot right now. So as more homes come into the marketplace, I think that's going to be something that will start to ease some of the issues as far as how tight these markets are. And then over the course of the next year, at the MBA, we believe that you could see a full 2% come off from 8% down to 6%. So as rates do decrease, which we are anticipating to happen by the end of Q4 2024, that could also be another incentive for people to get back into the market and increase and increase the home buying market.
Jeff Taylor, thanks. Good to catch up with you.
Thank you for having me.
Markets mixed heading into the close for the year. The Russell 2000 has underperformed, although there's been a lot of interest in small caps lately. There could be some headwinds on the horizon. Jared Blickery here with a closer look. Hey, Jared.
Hey, Julie, let's take a look at the Russell 2000 here. Down today 1.5%, but we've had some incredible moves recently. This is a 3-month chart, and only a couple days ago, we got this huge green candle right here. That was up 5%, best day in months. And off of that, we had Ryan Dietrich. He was noting, and I'll quote here, 97% of the stocks in the S&P 600, that's the small caps, it's like the Russell 2000, they closed green yesterday. That was the best day in 12 years. Rarely see days like this in a bear market. This was more than just a bear market rally, like they are telling us. And so let's kind of take a look at some of the technicals here. First, I want to throw up the 200-day moving average, and we'll see if this, if I lose everything here or if I can regain it. We just kissed the 200-day only yesterday, and let's see if I can take this off. There we go. I think we're back to normal here. We just kissed it yesterday, and we have backed off. A lot of times these things are self-fulfilling. However, in the longer term, let me show you, over the last 2 years, we are simply in a sideways trending market. So I think there's room to run up to the 2000 level, but I want to show you something here too. This is kind of a bigger picture concern. We do have the S&P 500 versus Russell 2000 ratio. That has now exceeded the 1990 level, and it could mean that we have more mega cap dominance on the way. In fact, we could head all the way up to here. On a short-term basis, we do have seasonality favoring the bulls into February of next year. That's on an relative outperformance basis. So we could very well see the Russell 2000 get to some of these targets I've been highlighting, but caution is warranted because, as I am pointing out here, let me just close with this chart right here. This is the small cap fiscal cliff. Long term into 2030, they got a ton of debt to roll over, especially long-term debt, and we know that interest rates probably higher for longer here, guys.
Jared, thank you for that. Appreciate it. Wall Street thinks the Fed is done raising rates, especially after that latest CPI report showed inflation is cooling. But some central bank officials, they don't want to put the cart ahead of the horse just yet. Cleveland Fed President Loretta Mester telling CNBC they need to see more evidence inflation is moving toward 2%. For more on this, we turn to Michael Aroney, Chief Investment Strategist, U.S. Spider Business at State Street Global Advisors. Michael, thank you for joining us. And I want to get right to that point. You know, Michael, a lot of investors clearly thinking they saw those cooler than expected inflation reports, and they determined, okay, the Fed's done. The rate hiking campaign is over. What do you think?
I think the rate hiking campaign is over. I think the Fed, with inflation, all item CPI at 3.2%, it's not 2%. They're going to have to continue to talk tough on inflation to keep their inflation credibility going. But at the end of the day, you look at numbers this week like the National Association of Home Builders, industrial production, retail sales, inflation. It's clear that the economy and inflation are coming the Fed's way. And we haven't even really felt the brunt of all the rate hikes yet. So I think the Fed's done. They're just going to have to talk tough for a while.
Hey, Mike, it's Julie here. It's great to see you. So does this mean up, and away for stocks from now till the end of the year?
I think it's a nice setup for stocks here, Julie. And the thing that's really fascinating for me is that interest rate volatility has dominated it. And what's interesting is that it's dominated the dispersion in stock market returns. So not to be a goofy wonk here, but basically bond market changes have dominated stock market kind of volatility to a level that we've rarely seen in the last 70 years. So here's the thing, Julie, is that historically, when you see something like this, I think investors get a little wigged out, to use a technical term, about volatility. They get concerned. But historically, it's been a bullish sign for stocks. And on average, over the next 12 months, they're up 16%. And to tie it in with your previous segment, usually value and small cap are the ones who lead the way. Why this is important is because in order for this rally to continue, we're going to need greater participation beyond just the Magnificent Seven. And I think we're going to get it as interest rate volatility cools as the Fed ends its tightening cycle.
So, Michael, if you're right, and the market's going to move higher here into 2024, what sectors do you want to be in, Michael? What look attractive to you?
So we have a bit of a mix here of both growth and cyclical. So we continue to like energy as supplies remain constrained. as kind of we make this transition from fossil fuels to something different. Admittedly, it's a multi-decade transition, but the stocks are pretty cheap. They're returning capital to shareholders. They've had good capital discipline. And our view is that that's likely to continue to be a tailwind for the energy sector. We also mix that in a little bit with technology communication services. Certainly not cheap from a valuation standpoint, but growth prospects look pretty attractive there. And kind of mixing in with industrials where profit margins are expanding. And we like those four sectors. And as you can see, what's absent is defensive sectors. So we think even though the economy may slow, we still think that a short and shallow recession's already been kind of priced in, thought of, anticipated. So we expect that those parts of the sectors will do pretty well.
This is so interesting to me, Michael, because, we're coming off of, we're always fixated on the latest thing, right? But I've got retail conference calls on the brain because we've had so many of them report over the past couple of days, and a lot of them are talking about a stressed consumer. Even the ones that are doing okay are talking about that stressed consumer. So it's interesting to me that you're talking about this sort of dichotomy between the economic backdrop and how these stocks might still do okay. Not retailers necessarily, but writ large.
Right. I think it's interesting. So, Julie, just think of 2022. The economy expanded, earnings grew. We had the best labor market we've seen since the late 1960s. And what happened in markets? We had the first dual bear market in stocks and bonds in a singular year, and one of the worst years for a 60-40 portfolio in history. This year, we had an earnings recession. We've had kind of some challenges in terms of geopolitical risk, and yet markets have largely shrugged it off. So I think from my perspective, it looks like earnings have probably bottomed. I don't think they'll be as good as analysts are anticipating, but they'll be good enough. And I do think that the interest rate volatility, what's again interesting is that it is dominating stock market performance. And historically, that's been a bullish setup because what happens is you won't stay volatile for long. And I think that ultimately, as the Fed concludes its tightening cycle, you'll see this interest rate volatility dampen. Rates are likely to fall, and I think that'll be bullish for stocks next year.
Michael Aroney, great to see you. Thanks for being here today.
Thanks, Julie.
Coming up, we got the closing bell on Wall Street. We'll be checking on the latest market moves and the top trending tickers. Stay tuned. We're just minutes away from the closing bell, so let's take a closer look at some of today's trading action here on the Wi-Fi Interactive. The Dow remaining in the red here. A little baby recovery heading into the close of trading. We've been talking a lot about small caps today. They're off by 1.5% today. We've also been talking about what's going on in the Treasury market, where we continue to see declines. And also a quick shout out to what's going on with oil. We continue to see a tumble in oil below $73 a barrel. And we're going to talk a little bit more about what's going on in the oil market in just a minute. Well, we should point out, energy, Josh, is the worst performing group today.
Yeah, and it wasn't so long ago, Julie. We had guests on, we were asking them, hey, how long till we get to $100? Remember
right,
that? I
yes.
mean, really quickly, how quickly that turned. I think just from geopolitical risk to demand is what you're seeing there.
Well, and even Michael Aroney of State Street, who we were just talking to a moment ago, said he still likes energy stocks, which he thinks can perform in the environment that we're going to see over the next year. We should mention consumer staples down a lot today. And just to go back to some of the trending tickers and look at how some of the big stories of the day, let's see, are closing out the day. Walmart, of course, is in that consumer staples group. And so it finishing down by about 8% on the day, following its disappointing forecast and really the disappointing commentary over what's happening thus far this quarter. Another standout, Cisco, off by 10% on the session.
Considered still, listen, that is still considered a name you look for as a kind of bellwether for tech spending.
Yeah. All right, well, there we have the closing bell on Wall Street on this Thursday as we see sort of a middling kind of day in the markets writ large here, with the Dow trading off by about 45 points, 0.1%. The S&P up by about 0.1%, and the Nasdaq also up by about that same amount. We talked about some of the groups on the move today and kind of the focus of investors here on the retailers, on what we're hearing commentary-wise from some of those companies. We also had some Fed speak throughout the course of the day as well, not really sort of dissuading investors from the current view that we are going to see any kind of an increase in rates at the next meeting.
Nope. All right, well, let's get some trending tickers as well here. Mizuho upgrading Intel to a buy with a $50 price target. Firm noting Intel's now refocused on a better 2024 roadmap, which could drive data center and PC share gains and improve margins, they think. So this one, Julie, Mizuho goes to a buy. Of course, the stock has already ripped higher in 2023, right? So they're moving in. I mean, it's already up about, let's call it 60%, but Mizuho, now a believer, they go to a buy. That price target goes to 50 from 37. I think new server products on the way. That's part of their bet that has them excited. And they think we're going to hear more about foundry customers in the coming months. The foundry business, meaning making chips for others. And we know that, of course, has been a big focus for CEO Pat Gelsinger.
Yeah, and they sort of see more clarity around the company's plans here. They talk about an improving data center roadmap for the company, product launches that they're anticipating that are going to be coming out from the company. They call 2024 one of the most prolific product launch years for Intel. So that's one of the things that they say is going to fuel some of the gains for the company. It's interesting also this upgrade coming even as we heard from Microsoft yesterday, which is introducing some new AI chip products on the ARM architecture. And we know that this is listen, it's always a competitive time in chips, but it feels like an unusually competitive time in the chip space. And at a time when, yes, Intel stock has really rallied, but it's still, in the eyes of many investors, playing some catch up here.
Yeah, although a tremendous run this year. And if you look at the street right now, to your point, Julie, still about 62%, the majority are on a hold on the name. So waiting to see maybe how some of these new products, what kind of demand they really see.
Yeah. All right, let's talk Sonos.
Sonos shares surging after teasing a plan to expand into a major new product category. CEO Patrick Spence saying the company expects to generate over $100 million from new product introductions this year. So new product, and the reports seem to suggest that maybe that new product, reportedly, Julie, is going to be headphones.
Right, there had been some reporting that's what they were thinking about.
Bloomberg says, by the way, the company's been working on headphones for more than 4 years. The board we should mention the board also authorized capital return news here, new $200 million buyback program. That never hurts. Brent Till at Jefferies, we know Brent very well, has a buy in the name, says yes, initial guidance, the offer was kind of weak for 2024, but he likes these headphone news.
Yeah, he says that the launch of a product product like that would be a no-brainer, he was quoted as saying here. And what I find really interesting is you and I we looked at Sonos yesterday after the close, after it reported its earnings, and the stock wasn't doing anything. And then it just took Patrick Spence, a product teaser here, the new product is coming, in order to get that stock to shoot upward on the hopes that indeed, this is something we've had Patrick on Yahoo Finance a number of times, and our Brian Sozzi has asked him a number of times, what's the next thing, Patrick? When's it coming? What's it going to be? And he's been very coy on that front. So I guess him giving any kind of little hint of news is enough to drive the stock higher. We are a heavy Sonos household.
Are you?
I don't know that we'll go into
you got
the headphones.
Speakers, the devices, the whole thing.
It's speakers. That's all they sell right now. Just the speakers. But we got a bunch of speakers.
For them, it's been, I know it's been kind of softer for them. And listen, it's not just them. Consumer tech spending overall has been a bit rough and under pressure. So maybe this is the move, the headphones.
You can
get
only
people excited.
Buy some. You only have so many rooms in your house at a certain point.
There's only so many Hymens. Come on.
Yeah, exactly.
Right. All right, moving on. Oil extending its declines here, falling below $75 a barrel. The move lower comes as U.S. oil stockpiles rise to the highest level since August, while concerns swirl over China demand. Joining us now is Tom Kloza, Opus Global Head of Energy Analysis. So, Tom, I don't know if you heard, I was talking to Julie. It was not long ago at all, Tom. We were asking guests, hey, we're in spitting distance of $100. Now I'm looking at Brent here, Tom. It's at 77.47. Explain this move to us, Tom. Is this just the conversation, the focus? Is it moving from geopolitical risk to demand? Is that what's going on?
Well, I think that the predictions of $100 and higher were really hyperbole. And they were based, coming from people who had a vested interest in prices going higher. The reality is that between the summer and the beginning of the winter, you tend to see a down cycle for crude that would take Brent to probably about 72 and change. And so what this proves is that you can have problems in the Middle East and you can have all sorts of geopolitical possibilities, but until you prove it to the market, they're not going to pursue those higher crude prices. And in the meantime, we're seeing the lowest wholesale gasoline prices since March of 2021. So there's going to be a significant tailwind for consumers on their expenses for fuel.
And Tom, you're also looking at sort of the seasonal factors going into early next year, and you're watching what big funds who hold energy do with those holdings. Is this something that tends to happen at this time of year, or is there something this year that makes it particularly interesting to watch?
Well, Julie, the biggest fundamental in the price of oil is money flow. And right now, it looks as though some of the huge funds that manage commodities across the spectrum are going to have to get rid of some of their holdings in WTI and Brent in January of 2024. That might be $3 billion of investment money coming out of the market. So that's going to be a real hurdle. And if you combine it with a warm winter, which I believe the folks from the National Weather Service today predicted a warmer winter for the places that use heating oil, it's going to be very challenging for oil prices. Now, we haven't heard from the Saudis yet. We'll hear from the Russians, but when they say they're going to cut production, it doesn't mean anything. But I suspect that next week at the OPEC meeting, we'll see the Saudis talk about continuing their unilateral cuts through the first quarter of 2024.
And Tom, when you think about your outlook for oil, where it heads from here, how does China play into that?
Well, China has been the dog that hasn't barked all year. It really hasn't. China is very, very weak. They imported a little bit more crude last month, but if you look at the PMI indices and some of the other measurements of Chinese economic demand, it's not exactly gangbusters. So that might be something to throw in the mix in 2024, but they've been missing in action in most of 2023.
Tom, put it all together for us in terms of what all this is going to mean for U.S. consumers. We've been talking a lot about, with retail earnings out, the various dynamics that are going to be at play during the holiday season. What about gasoline?
Well, people are going to have more money to spend based on spending less for gasoline. I think that we're going to go through Thanksgiving weekend with an average price well under $3.25. And I think most people in the country, with the exception of those on the Pacific Coast, are going to be able to buy fuel for less than $3. And, I always say this, gasoline is special when it comes to money that you spend on it. When prices go higher, people get annoyed by high gas prices, like I get annoyed with the Dallas Cowboys. So it doesn't have quite the visceral response that we've seen in the last couple of years. And that's a good thing for a consumer outlook and for sentiment.
But they might cut back on their purchases of gasoline. Do you stop going to Cowboys games when you get annoyed with them, Tom?
Well, I'm a Giants fan, so I'm kind of pathetic these days.
Okay.
But yeah, that's a real problem.
Tom Closa, thanks so much. Good to see you.
Thank you. Thanks for having me.
We were just talking about the Chinese effect on oil. Let's talk about China's oil demand rising. President Biden worrying about gasoline prices. We've also got a ready supply of Mideast oil. All of this is something that both leaders can agree on as they continue the dialogue that began at that rare in-person meeting yesterday. Rick Newman has been watching that for us. So we know there's not much they can agree on because not much came out of yesterday, but lower oil prices are good for both.
I mean, this is the thing I kept thinking of as I watched the coverage of Biden and Xi meeting. Oh, they made a little disagreement. This is actually important. The militaries are going to communicate more. They are going to talk more about shared interest in climate change. But there's a huge shared interest both presidents have that nobody's talking about, which is keeping oil prices low. And ironically, President Xi of China may have more ability to do this than President Biden here in the United States. We've had massive shifts in the flow of oil around the world during the last few years. Some of that is just where the new customers are. Some of it's relating to the war, sanctions on Russia and Russian oil. But the United States used to be the biggest customer of the Middle East oil exporters. No more. The biggest customer of Saudi Arabia, Iran, and most of the other big producers is now China. So as this war has erupted between Israel and Hamas, I mean, of course, at the beginning, there was concern. What if this spreads to oil markets? We saw a little bump in oil prices. They're now way lower. And you have to believe that behind the scenes, China does have some influence with Iran. They're its biggest customer. The question has been all along, Iran is behind all the mischief makers in the Middle East. Is Iran going to do something? Iran, I mix it up. Are they going to do something to make this a bigger war? And you got to believe that China is sitting there saying, we really don't want to see oil prices go above $100 per barrel because that is in China's interest, just as is in President Biden's interest to keep oil prices low. I can tell you the White House is obsessed with gasoline prices. They saw what happened to Biden's popularity when they went all the way up to $5. Biden's popularity went down, has not come back up, and they know they have to do everything to keep gas prices low in 2024.
So Rick, do you think now the gas prices are coming under pressure here, maybe even heading lower? Good news for Biden?
Absolutely. I mean, there's a direct correlation. The guest from Opus was talking about, he said gasoline prices are special. They have an massively outsized effect on consumer psyches. The average household spends only 3% of its budget or so on gasoline, way more on food and way more on housing. There's just something about those gasoline prices, 2-foot high numbers everywhere in the country. Even if you don't drive that much, if you see, with these threshold numbers have a big effect. When it goes over $4, people just think something's wrong. God forbid it should go over $5 as it did in 2022. That's like a disaster. So that just tells people something's wrong. I have a different metric. I go by the price of avocados. When avocados are like less than, you got to have a household supply of avocados. I mean, when avocados are like $1.50 or less, life is good to me. And when it's like $2 or more for an avocado, you remember when like the cartels got control of the avocados or something? I was like, oh. But for more people, it's gasoline prices.
Where do you go for your avocados? Where do you get the best price?
Wherever the best price is. And I don't care about organic either.
I go to TJ's. That's usually where I find the cheapest avocados.
Yeah.
I don't know.
Avocados.
The avocado index, yeah.
It's the Rick
index. I haven't been eating enough avocados lately. This is a good reminder for me. Thank you, Rick Newman. If I take nothing else away from this, gasoline
and avocados, the only things that matter.
Exactly. Coming up, our next installment of Yahoo Finance's week-long healthcare special. Now we're looking into the future impact of AI on the industry. That's after the break.
A major milestone for the Biden administration, 2 years since the signing of the historic infrastructure package. Let's welcome in to the show right now, Transportation Secretary Pete Buttigieg. Mr. Secretary, always nice to get some time with you here. So as someone that has been the driving force, you've been touring the country since this package was put into action. What are some of the projects you are most proud of?
Well, what I really love about this infrastructure package is it's funding projects of all shapes and sizes. Everything from the announcement that we just made at the Hudson River Tunnel. President Biden announced a new round of funding under the law that he signed 2 years ago that brings us to an $11 billion commitment, making it one of the biggest public works projects in modern American history. All the way through to things like the airport I visited in Chamberlain, South Dakota, which is very important in that town of 2,600 people because of its role in crop dusting and in medical evacuation flights that get people to the hospital. With a grant of less than $1 million, we're able to help them take a terminal that had been built out of a mobile home and get them a more appropriate facility for the needs there. So in every state and territory, we're seeing a total of over 40,000 projects that have been identified. And again, some of them, I call them the cathedrals of our infrastructure, rebuilding airport terminals, taking care of bridges or tunnels that are 100 or 150 years old. Others are more backyard projects that will rarely make national news, but are some of the most rewarding ones for me to hear about and for me to visit, because there's enthusiasm for those in some of the same communities that have been left out in the past.
Is there an estimate you're able to point to on how much in terms of job creation this plan has put forward?
Well, what we have seen overall is that our economy has added hundreds of thousands of construction jobs. And if you think about the way the ramp up works, that's only going to accelerate as we go into the next year. It took a while to get those multi-billion-dollar programs up and running and then to get the money flowing out the door. So it's really starting this year and accelerating next year that you're seeing the construction start to happen. We also saw some really encouraging news in a report that recently came out from Treasury, showing that investment by state and local governments in public infrastructure, it's at an all-time high since, or it's the highest level it's been at since the 1970s. And when you see that happening, the state and local investment unlocked by the federal investment, it shows that America is finally doing what we should have been doing a long time ago. One other nuance in that report that I think is interesting: historically, sometimes big infrastructure investments reinforce inequalities. They tend to be highest in the highest income areas. This time around, the data are actually showing that it is in lower income states that we are seeing higher rates of investment per capita. And that's, I think, very fitting, because infrastructure can be a great equalizer that helps more people access opportunity, access jobs, and get their shot at the American dream.
Mr. Secretary, Yahoo Finance recently ran a poll in partnership with Ipsos, and two findings really came to mind, or came to light, at least for me. One of them, a lot of Americans say they still haven't felt the impact of plans and efforts like this by the administration. My question to you is, why do you think that's the case?
Well, a couple of things. First, a lot of the infrastructure investments that we're making play out over a long period of time. Look, some things we're doing, simple road projects, can be done in one construction season. Others are multi-year, multi-state projects. A new airport terminal or replacing a tunnel that's 100 years old is something that will take a while to experience the complete finished product. But what will happen much sooner than that are the construction jobs. The second part of it, and the one that I think is important to remember about infrastructure, is actually the better it's working, the less you notice it. Infrastructure is just supposed to be there for you when you need it. Whether we're talking about getting a glass of clean, safe drinking water out of your tap, or whether we're talking about having a smooth, safe road to drive on when you're dropping your kids off at school or headed to work, the less you have to think about it, the better. Of course, in order for that to be true, we have to think about it. At the Department of Transportation, policymakers in Washington have to think about it, are supposed to make these investments and worry about American infrastructure so that most people going about daily life don't have to.
Lastly, we're coming up against Thanksgiving. And really, this has been, and we've talked to you a lot about this is one of the worst years for delays at this country's airports. What are your messages to the CEOs of these airlines that I think some would suggest that they've pulled back on investment in some areas of their business, maybe to boost profits, whatever it is? What's your message to them as we might be looking for another holiday season of chaos here?
Well, look, we know that when there is concerted action, it can work. It's one of the reasons why cancellations are below the 10-year average right now, and we'd like to see the same thing happen with delays. That means realistic scheduling. And the other thing that I think is having an effect on airline behavior is we have dramatically improved passenger rights enforcement compared to even a year and a half ago. The passenger protections that people have, you can learn about them at flightrights.gov, are just at a different level than they were before. And that creates the right kind of economic incentive for airlines to do what they should be doing all along. Of course, we're not just coming down on the airlines. We're also making sure that the FAA is part of the solution, using GPS-enabled technology to create smoother, simpler flight routes, getting together on operational issues, and even things that sound a little exotic but are more and more of an issue, like deconflicting frequent commercial space launches from airspace that's busy for certain travel periods. But here's what we've seen so far this year: a reduction in cancellations, an increase in passenger rights, and an all-time record high in terms of travel in the summer holidays. I expect that we'll probably see the same thing going into the winter holidays, and so we'll be watching closely and ready to have passengers back anytime they experience an issue.
Well, luckily for me, Mr. Secretary, I'm just going down the block in my car for the holidays, so no airplanes for me. But it's good to see all the work you continue to do there. Transportation Secretary Pete Buttigieg, always a pleasure to get some time with you. Thanks for joining Yahoo Finance. We appreciate it.
Same here. Thanks for having me on.
And thank you, Brian, for that. Now, turning to our next installment of Yahoo Finance's week-long healthcare special, we're looking into the future impact of AI. It's no secret the AI boom has taken the tech world by storm, but it is actually not a new phenomenon in healthcare. Just how far it will go in the industry remains a question. According to a recent Deloitte survey, slightly more than 70% of generative AI users thought the tech could revolutionize care delivery. And here to dive into the use of AI in healthcare, we have Dr. Geeta Nair, former Salesforce Chief Medical Officer and author of Dead Wrong: Diagnosing and Treating Healthcare's Misinformation Illness. Geeta, thank you so much for joining us today.
Thanks for having me, Anjali.
So let's talk about this. AI in healthcare, not a new phenomenon, definitely been sort of functioning in the background, if you will, especially when we talk about drug use and development. But in the provider space, that's something that is holding a lot of excitement, if you will. There's a lot of people who want to know, is Dr. Google walking into the room now? Are we going to be diagnosed by AI? What do you have to say to that?
Well, first of all, as a technologist, I am thrilled and excited by the opportunities of AI, particularly in precision medicine and personalized medicine. As a physician, however, I am concerned about the implementation of AI. Just like we've done with so much tech, we've in many ways taken away the joy of medicine. So it's important that we focus this new tech on the protection of the patient-physician relationship and ensure that we're actually making our doctors faster, better, and happier, frankly.
I know I've seen surveys, and I know you've seen this too, where AI is supposed to sort of open that door, if you will, for more administrative tasks being handled by that. We've seen the launch of a number of AI scribes by big tech firms in the last couple of months alone. I wonder, when it comes to that part of it, of what it means to gain that time back for the providers, what does that do then? What is the underlying benefit to having those key technology impacted?
Well, look, time is priceless. And right now, when we talk about documentation for physicians and the technology revolution that's happened, it's taken away time. And it's taken away the joy of medicine, which is really the patient-physician relationship. So the companies that focus on the use of AI as it relates to clinical decision support, improved and automated documentation, prior authorization alone could save us billions and billions of dollars, and there is no doctor that enjoys doing prior authorization, let me tell you. So there's ample low-hanging fruit, but this idea that we're gonna go to Dr. Google, or a robot is gonna deliver your baby, patients don't want that, consumers don't want that, and neither do docs.
Speaking of prior auth, I know there's another area where AI has been thought to be used, and that is actually in claims and denials or approvals of that within the healthcare insurance space. Now, United Healthcare recently in the headlines for some unfair denials causing a lot of problems for seniors. I wonder, is that an example of what you think is sort of where we can't get to just yet? Is it too early for something like that, or should that not be done at all?
So again, we have to balance the buzz with reality. And AI is not ready to be left alone. We still need that human oversight, whether we're talking about prior auth or we're talking about documentation. So we're just not there yet because we're still learning. But secondly, we have to remember the healthcare industry is single-handedly keeping the fax machine alive. So while AI
not a joke, not a joke, it's true.
True. Walk into any doctor's office and you'll meet that reality. So we have to balance what's possible and the art of what is possible with the reality. And we need to focus on the crawl, walk, run, right? When you're learning something, you don't go having robots doing surgery autonomously. Not yet. I hope we get there, but we're just not there yet.
And a final question for you. When we talk about AI, of course, misinformation, something you recently wrote about in your book. Where do you think the role of that is? Where we talk about, what the trust, that underlying trust you were talking about with providers, what does that disconnect when AI comes in the picture?
So first of all, 57% of Americans trust their doctor, not their insurance company, not AI, not hospitals, right? So we have to focus on how can AI amplify that trusted relationship. And we have to remember that 59 million Americans turn to social media influencers for answers to their healthcare questions. So why not use AI to amplify that trust, to amplify the presence of science, and to win that trust back? Because there are just as many misfits out there using it to sell $29.99 vitamins, right, and supplements. So we need to flip the dynamic, and science needs a comeback, and AI could be part of that story.
Yeah, certainly we saw that in the vaccine rollouts and the like. Those are just examples of what we've seen in the recent past of how misinformation can do some damage. So definitely need some guardrails in there. Thank you so much for taking time to talk with us. Dr. Geeta Nair, former Salesforce Chief Medical Officer. Coming up, Starbucks employees at more than 200 locations nationwide are walking off the job today. We'll tell you why next.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investors Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
It is time for Yahoo Finance's group chat. We're looking at a few trending stories you need to know about. Let's start with Starbucks as employees at more than 200 locations walk off the job today. Look, it's Red Cup Day. That's kind of a big deal, no less there. Big day for big fans of the brand. But you know, the organizers of this walkout saying this is the largest strike yet in the 2-year-old effort to organize these stores. About 5,000 workers expected to take part in this big sort of strike. They're complaining about stuff like long hours, the unending ticket system from web orders, not enough pay. They're saying the company's not doing enough. Starbucks, of course, disagrees. They're saying, you know what, we're doing that. We're business as usual today. All like 10,000 stores still open. This is right outside actually our studio here in downtown New York City. You can see not so much disruption, but you do see the picket line there walking around the entrance there. So, you know, we've talked about this a number of times, labor having its moment here. But the question is, how far can it go? This is right after the UAW stuff happening. I think Starbucks is saying, hey, the organizers are saying, hey, we have a moment to kind of make a change here.
Yeah, I do think there's strength in numbers in these types of movements and situations. If you see one group or one industry, you know, standing up to these corporations, fighting for more rights, better hours, better pay, that's going to embolden you to want to do it yourself. I'm just not sure if there's enough momentum here. And yes, we were showing that there was a strike line, but the store itself was still open. You could still go and get a drink. You know, the labor group is saying thousands were participating. Starbucks itself is saying a few hundred. Of course, Starbucks is going to want to try and downplay this as much as they possibly can. But in terms of the actual number of stores being impacted, today at least, what this group was targeting, 360 out of more than 9,000 U.S. locations. So a very small number at the end of the day.
To me, though, when we think about the different strikes we've talked about recently, this has some of the most potential impact to hit home to someone that's not involved in the strike on the day of a strike, right? When you think about Starbucks coffee and how for coffee drinkers, that's a moment in their day, right? You go to get your coffee. So if your coffee's disrupted or your coffee shop's not open, like one of the coffee shops near us was this morning when people came to the office, people get upset about that, right? And it's something that then makes you maybe go to the internet, maybe look up what's going on, get a little bit more curious. And I know the other strikes were very broad, right? You think about the Hollywood strike, of course, we're gonna be disappointed when there's less movies, but there wasn't less movies today.
Look,
so you had to wait for that impact.
That's true.
And like the coffee is happening now. And so I think it can maybe aggravate consumers.
Take my cars, but
don't
not
take my coffee. Don't take my coffee, bro.
Interestingly enough, though, is that Starbucks is known to be actually somewhat generous with their compensation and benefits and the ability to advance within a store in their system, or franchise system. So it's interesting that they're saying, no, that's not enough. Are we going to see Dunkin' Donuts do this? Are we going to see other places where people are sort of working, you know, a lot of controversy at Starbucks. Remember the whole talking about sort of controversial issues, asked me about this stuff that was pulled back a couple of years ago. Remember that with, what's his name, Howard Schultz? Brought that. So, I mean, there's a lot going on there. It's like you said, it's a job where people are coming to you for, I need my caffeine fix right now. So if that's going to get messed up, or if I want you to be happy doing it, fine, just give me a coffee.
Yeah, it just hits home. Like yes, we all want a Ford F-150 at some point too, but you might not have been buying it today, right? And that production has a lagging impact where they're not going to have cars in say 3 months or 6 months, whatever it is. The coffee's today. and I'm not a happy person if I don't have my coffee.
And the headlines it made today is to your point. I mean, it was all over the place. People were talking about this.
And it's one real quick. Every job site has a Starbucks nearby, and they probably saw something like that, like we saw today.
Oh, yeah,
potentially.
Absolutely.
All right, another story we got our eyes on today. Robinhood CEO Vlad Tenev is going after big banks on their own turf, saying they're ripping off customers with low interest rates on savings accounts. So Robinhood now launching a savings account here that gives you 5% annual percentage yield on uninvested cash in your Robinhood account. Of course, this is sort of very Robinhood-esque, right? To go after traditional banks, say banks aren't doing what you think they're doing, banks are screwing you over as the customer. I can help you out as Robinhood. He fails to sort of mention in some of these assessments that you could just say have a money market account and get a similar 5% at a lot of the places that people do invest at.
People don't.
That's the main thing that stuck out to me. No, it's a great thing to flag from Vlad Tenev, absolutely. But my first thought was, let's not act like this is a new product here. It's just a new product to Robinhood.
But relative, though, with the average savings account about 0.6%, I mean,
He's 100% correct.
I do think it's a really smart move on the part of Robinhood. Certainly the stock needs it, although we did see shares close down nearly 5% today. So that's not great. The banks did issue, though, a statement of their own with the spokesperson from the American Bankers Association telling CNN, quote, banks of all sizes have a record of delivering dependability, safety, and convenience, as well as competitive prices. It's also worth noting that Robinhood can only offer FDIC protection on some of its products because it partners with FDIC-insured banks. So basically the ABA is saying it's more risky here to go with Robinhood versus traditional banks, and that Robinhood still relies on banks for some of those protections. But it brings up a good point with interest rates so high, and it gets you thinking as a consumer.
Right, and it's using those FDIC products from other banks to offer this product that they're doing. But he's not wrong at all. Talking about banks ripping people off, you're always going to get applause for that. And like you said, Josh, it's not like there isn't CDs out there, money market funds out there, but he's pointing out to people like the Zoomers out there that, hey, you can get more money for even a small amount of money. We'll
you see Prost point at me when he said Zoomers?
The Zoomers.
I mean, we were talking about it earlier. Now I'm looking it up, and SoFi, Lending Club, Capital One, Marcus, all paying 4 to 5%. Why am I not in those products as opposed to Citibank paying me 0.7 or 0.7 in the savings account? Forget that, right?
Yeah. Well, we'll have to see where that happens because Robinhood stock certainly not doing too hot year to date. But I've been looking at something else that we've been talking about really all earnings season, the shaky advertising market with linear TV ad revenue still in free fall for major media giants, despite other formats drawing higher spend. And it's really interesting to see the discrepancy here. Macquarie was out with a new note saying that on average, declines in linear ad revenue across media were down 12% in the third quarter, following a decline of 13% in Q2. The estimate for Q4 is, again, we're going to see another decline of 12%. And this comes as media managers, they've said that they expected the back half to be stronger when it comes to linear TV. That clearly didn't happen. That's one of the reasons why we saw Warner Brothers Discovery stock fall so much yesterday, because they basically said, we might not be able to hit our leverage targets because of the ad environment.
It's linear TV's fault for just not having that cool content, right? Outside of live sports, like what are the cool shows that you talk about with your friends and you watch? They're all on streaming. You want to be, if you could be an advertiser and you're advertising in the content space, in the TV space, you want to be in your characters.
That's the new shiny thing, ad-supported,
I would rather go spend some ad money on Netflix.
Well, I think the issue is not that the content sucks, it's the fact that you have to watch commercials, and I'm just going to record it, I'm going to fast forward and watch it on demand. Like, I don't need to actually watch the commercials. I mean, what's the hope for linear TV now, right? Go behind a paywall, go full product placement on everything. I just feel like it's a dead business, and all they had was sports, right? Live sports, and you were saying that might be going away too.
Even the ad scatter there, which is basically the ads that's available, not purchased at the upfronts, that's been on a 7-year low at this point for the NFL games. So not even sports can really save it there. And, just across the board, non-linear ad spending is doing well. Podcasting revenue, that's up. Fast channels, free advertising video on demand, like Roku, for example, is doing well. Even the tech giants, YouTube, that did well. So it's one of those things that you have to wonder what the future is for linear.
Probably won't be us going to watch linear TV right now. But coming up next, we're going to take a look at shares of Gap popping after reporting third quarter earnings. We're going to bring you the numbers after the break.
Shares of Gap are trading higher after reporting third quarter earnings. The company beating on the top and bottom line, blowing past earnings expectations. To dig into the latest quarterly results, we have CFRA analyst Zachary Waring. So Zach, comp sales fell 2%, but that was versus the almost 9% that analysts were estimating on average. So Richard Dickson is the new CEO here. Is he doing something right? Is that what's going on?
Thanks for having me. Yeah, it's a little early to tell if it's him doing everything, but they're definitely going in the right direction. So, gross margin improvement is the big thing for them. They've struggled having, significant margin expansion in recent years, and they're doing that now. So that's why you're seeing the reaction to the stock and after hours. But we'd like to see their bigger brands. So obviously Old Navy had pretty, strong sales this quarter relative to other retailers. But we'd like to see Gap and Banana Republic sales stabilize. And then also, Athleta, what was supposed to be their growth brand, sales were down 18%. So we'd like to see that turnaround as well.
And CEO, Richard Dickson, he's been in that position now, Zach, since the summer. You kind of hinted at this, but what are the moves he has made that you think are positive, and what maybe would you still like to be done?
Yeah, so he's clearly doing well to cut cost. He's had some tailwinds. Obviously, freight costs have come down significantly in the last 12 months. So that's been a tailwind for all retailers, and it has, for this year, boosted gross margins compared to last year. I'd like to see, like I said, those improvements to those other brands. He's doing something right at Old Navy because sales, like I said, they're only down 1% compared to retail. Most retailers have reported sales down 5 to 10% in the last few weeks. And then Banana Republic, was kind of had some momentum going into this quarter, but sales were down 11%. So I'd like to see those sales stabilize. And it might just be that the consumer in the U.S. is a little weak because you're seeing it across the board.
One of the other positives here is that much like many of the other retailers, inventory was down, in this case down by 22%. So it seems like, it feels like retail broadly, and Gap specifically, are hoping to position themselves from a cost perspective better once sales hopefully start to improve. Is that how investors should be thinking about it?
Yeah, so Gap and a lot of department stores and on-mall retailers have done well in recent quarters to get their inventory levels back down. It's been an issue over the last 2 years just because the consumer in the U.S. was extremely strong. So, companies over-ordered. But they've done well, and it's obviously has improved significantly since, last year in 2021. So, yeah, I think that's definitely a part of it. I think, retailers are being a lot more smart about their ordering. They're not over-ordering anymore. And I think the supply chain has also helped most of these retailers this year and has been a tailwind for gross margin.
And Zach, so, this name was already up about 20% year to date heading into this print now. It's surging here in the after hours, up about 14%. In terms of valuation, you got to sell on the name, Zach, so I'm guessing you don't see it as that attractive. Which valuation metrics are you watching, and what do you want to see before getting more constructive?
Yeah, so, my valuation was on much lower EPS for the year, so that will have to change. I do think that before you can get really bullish on the stock, you've got to see these large brands return to some sort of stable revenue or top line, and then you'd like to see Athleta, which is supposed to be their growth brand, kind of turn around and reverse its negative growth.
And Zach, final question here, kind of a broader one for you, but you know this name, but you also just know this space. We've been having these discussions about kind of the low-income consumer, and some on the street, some of your colleagues, Zach, they've talked about how they do see signs of this kind of low-income consumer recession, and they're looking at savings, they're looking at credit quality deterioration, they're looking at confidence. As you look through these reports, through these earnings releases, you listen to the CEOs make their commentary, are you seeing signs of that?
Yeah, absolutely. Especially in apparel and footwear retail. Obviously sales are down. Like I said earlier, they're down 5 to 10% this year in this quarter compared to last year. So consumers aren't spending as much, and where they are spending, they're looking for deals. So you've seen apparel and footwear off-price retailers like TJ Maxx and Ross do well because they're gaining a lot of those low to middle income consumers who are trading down. And I think Gap kind of falls into maybe the lower middle income consumer. They somewhat benefit because they do have lower prices on most of their apparel.
CFRA analyst Zachary Warren. Thank you so much, Zach, for your time.
Thanks for having me.
And coming up, IBM now pulling its ads off X, formerly Twitter, after a report they appeared next to pro-Nazi content. We have more on that fallout on the other side of this break.
X, of course, the platform formerly known as Twitter, losing an advertiser, at least for now, after Elon Musk boosted an anti-Semitic tweet and back to claim that the ADL and other Jewish groups are pushing anti-white messaging. Now, specifically, IBM, an independent media watchdog, flagging that there were some anti-Semitic tweets that were next to an ad from IBM. So IBM saying in a statement to Yahoo Finance, IBM has zero tolerance for hate speech and discrimination, and we have immediately suspended all advertising on X while we investigate this entirely unacceptable situation. In the meantime, ex-CEO Linda Yaccarino posting a short time ago that discrimination should be stopped across the board, but she didn't mention anything about Elon's specific tweets or address the specific situation with IBM. Listen, this is something that critics of Elon Musk have flagged from the beginning when he took over Twitter, that this would be a risk. And we've gotten dribs and drabs of it, but IBM's a big advertiser.
Yeah, big. I mean, you think about Linda Yaccarino, too, so the CEO of X, and she was brought in, of course, because she's an ad czar, right? I mean, this is her background, this is her experience. She's the one with the context of Madison Avenue, and so the idea was you would bring her in and she'd work that Rolodex and get these marketers excited again about putting money to work on this platform. But Musk has proven a challenger because, one, he weighs in just on every political, social, cultural issue, right? And now you have drama like this, it makes it that much more difficult for Yaccarino to do what she was hired to do.
I mean, and to be fair, a lot of the social media platforms are grappling with anti-Semitic content right now. There is a story in the New York Times today that a number of Jewish celebrities are confronting executives at TikTok about this very issue as well, that they are not doing enough to stamp out this kind of content. But when you see Musk himself boosting tweets that are questionable at best, you get there's a complicity problem, there's a credibility problem in the eyes of advertisers.
Yeah, I mean, listen, IBM is a big, well-known brand, a big name. We'll see if others follow suit.
We will. There again, that Media Matters report did flag some other companies whose ads appeared alongside some of these questionable tweets.
All right. Time now for what to watch on Friday. BJ's Wholesale closing out a jam-packed week of retail earnings. The membership-only warehouse club chain expected to report its latest quarterly results. That's before the opening bell. This coming as investors saw some retailers lifting their outlooks while entering the holidays, but many proceeding with caution as consumers face economic uncertainty. Meanwhile, on the housing front, we're going to be getting a new read on housing starts and building permits for the month of October. Housing starts expected to edge slightly lower after rebounding in September, while building permits are also expected to fall slightly from the previous month. And lastly, expect to hear more remarks from the Fed this week. Fed officials Susan Collins, Michael Barr, and Austin Goolsbee and Mary Daly all expected to speak on Friday.
And we'll be here too. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Good night, everybody.